Right. Good morning to our lovely audience, and welcome back to Boutiques on Wednesdays on this very fresh winter morning in South Africa. I know some of our panelists this morning are not in SA, so they're not experiencing winter. Thank you all for joining us a little bit longer to accommodate our global fund managers dialing in from all over, and we'll introduce them all shortly. With the Fed warning on further liquidity squeezes, it appears as if absolute returns or upside for equity markets are constrained by both higher valuations and interest rates to remain longer or higher for longer than the market has priced for. With no sight of the much expected recession, there's less urgency, obviously, for central banks then to cut rates. Some analysts expect zero profit growth for the rest of the year, but is that true for all growth assets? Who knows? And with geopolitical tensions increasing, as we've seen over the weekend, what is the outlook for global equity? It is my absolute pleasure to welcome Chief Investment Officer of Korean Capital, David Bacher. David, good morning. Thank you so much for joining us. I believe all the way from Israel this morning. So thank you so much for dialing in. David, before we start, maybe just for the audience, I think most of you know Korean. You receive the monthly Korean report compiled by David and his team, but is they also one of the longest standing multi-managers, or DFMs, call them what you want, in South Africa, founded already in 2001 and with a very impressive track record. So David, really thank you for your time this morning and coming in all the way from Israel, busy with all your global travels. We really appreciate your time and looking forward to your panel discussion on global equity.
Thank you, Eugene, and thanks for the honor. So we've got today really 4 very experienced global equity managers, and all of whom are very well known to South Africa. And there's lots of interesting topics to cover. So let's get straight into the discussion. I'm first going to ask each panelist to introduce themselves, but at the same time, I want them to briefly explain the investment strategy, and most importantly, to tell our listeners why they believe it's an appropriate time to invest in their global equity strategy. So I'm going to start with Simon. By introduction, Simon Rubenheimer joined Contarius in 2019. Prior to that, Simon co-managed Adam Gray's equity and balance funds. Welcome, Simon. And as mentioned, please very briefly describe Contarius's investment strategy, and importantly, tell the listeners why you believe it's an appropriate time to invest.
David, I know Andrew mentioned that there might be a problem with his screen. Okay. I think he's redialing in. If you maybe can continue with the rest of the guys, and we'll check out keep an eye out for Simon hopping on again.
Sure. Okay, well, let's go to our next panelist. Same question for you, Ben van Leeuwen. Ben is an analyst at Lindsell Train. Ben, I noticed that you have a degree in English and Language and Literature from University of Oxford. So I hope my grammar and my questions are on song today. So please provide the audience with a bit of a summary and why you think it's an appropriate time to invest in your global equity strategy.
Absolutely. Thanks very much, David. Well, then briefly just on Lindsell Train to start. Set up in 2000, we have 4 funds. We run around 20 billion sterling, and it's a very simple, straightforward strategy: 20 to 25 holdings per fund. So fairly concentrated and super low turnover. So the global equity portfolio has averaged around 4 or 5% for the last 11, 12 years. So we've got that implied holding period of around 20 years. So it really is buy and hold. And most activity that we've seen has been, inadvertent corporate activity, companies acquiring or so on. And then the profile of the companies we're looking for, I think we're pretty securely in that quality camp, although it's a fairly nebulous term, but centered really around staples, media, and certain financials and marketplaces. As for why now, with Lindsell Train, I mean, given the turnover and so on, as you can see, we're not designing our portfolio for any one specific moment in time. It's designed to be a kind of portfolio that you would be happy holding on to through a variety of different kind of external scenarios. But, you know, as ever, I think buying into the kind of companies we like, which are typically resilient and able to kind of weather these current crises. Yeah, let's hope now this is equally compelling in time as any. And I'm sure when we get into the actual stocks, we can discuss in more detail why each we think are well positioned to navigate today just as much as 5 years ago and 5 years into the future.
Thank you, Ben. Simon, are you back with us?
I'm back. Sorry about that. My screen went
go
black.
for it. You know the question, and if you can briefly give us an answer. Thank you.
Yeah, so we are true contrarian managers, which means we go very much against the herd. We take a long-term view, and we buy shares that we think deliver a potentially unattractive rate of return over the subsequent 4 years. I think our strategy does particularly well following periods of market dislocation, when there's or periods where there is extreme sort of disparity in the market. And we've had several of those periods in the past. I mean, you can go back to 2009, the GFC, or the end of 2015, when there were issues around China, Greece, and commodity prices. We had it again now in 2020 during COVID. And we think even now, at the moment, the disparity in the market is still well above normal. And we are finding extremely cheap shares and are very excited about the prospect of our fund over the next few years.
Thank you, Simon. Our next panelist is Jared Khan. Jared is a portfolio manager and head of equities at Credo. Jared, if you can just, maybe I'll repeat the question, you know, why do you believe it is appropriate time to invest in your strategy, and at the same time, give us a brief overview of how you manage money?
Thanks, David. So, you know, we run money, and we'd like to identify ourselves as somewhere between the intersection of value and quality. And I think it's no secret that over the last decade, it's really been a time for growth investors. But our view is, if you look over history, over the last 100 years, value has been a philosophy or strategy that's outperformed. And I think that the alignment for value is very much still in vogue, although we've had a little bit of a tough time in the last, say, 6 months. So I think value, if you're looking for value, value is a great investment to be in. In terms of how we manage money, as I said, you know, we kind of play in the intersection of quality and value. And I think both those strategies have been under pressure over the last while. And that's why this is a good time, I think, to be slightly contrarian, given the valuations of some of the growth companies out there.
Thanks, Jared. I think a lot of value managers on this panel, and it's a good lead into our next value manager, Andrew Lappin, previously the CIO of Allen Gray, and now at Randmore as an investment advisor. Over to you, Andrew.
Thanks, David. So a brief intro on Randmore. Randmore's been running since 2008, so 15 years now, looking at global stocks with exactly the same strategy throughout the entire period. And that strategy is a value strategy. So we look for companies that any sector, any area across the world, we're looking for businesses that we think are undervalued or that the market doesn't appreciate their qualities, where importantly, management is on our side. So we're not in favor of companies where management is trying to enrich themselves at the cost of shareholders. So the other thing we take seriously is risk, and often that is a financial gearing, and those are the type of businesses we tend to avoid. So good, stable businesses trading at well below value. And is this a time for our strategy? Well, we think there's always an opportunity for value, and I would encourage people when they're choosing funds to say, we don't want this type of fund for this period or that type of fund for that period, but rather try and find a manager that they're going to stick with through the cycle. So that's what we would encourage people to really understand the philosophy and choose a manager that they believe in and will stick with for years. Thanks, David.
Thank you. Ben, just reviewing your answer to the question, you focus on a lot of the industries that is a core to your proposition, but there are some sectors that you omitted, basic materials, energies, etc. You know, that is a large part of the market, and obviously has its day in the sun. You know, what's your answer to investors when those shares run, or we are in a cycle which is where that part of the market has a lot of tailwinds?
Yeah, put quickly, I mean, it's painful. So in 2021, I'm sure we missed out on a good chunk of performance that others will have managed to hold on to had they had exposure there. But as you say, it's this whole idea of moment in the sun that we want to avoid, partly because we don't want to second guess when those events are, but also just we'd rather own shares that have kind of secular long-term tailwinds without those kind of fluctuations. And we just think we can find stability elsewhere. There are, you know, multiple other reasons. I mean, we don't like being exposed to extraneous things like the price of certain commodities. I mean, we'd rather just, you know, be very convinced that everyone's still going to be eating Cadbury chocolate bars in 20 years, rather than trying to second guess a lot of, you know, these other factors that go into that. But no, I mean, if you want that exposure, then 100%. You can balance it elsewhere, but it won't be probably within our 20 to 25 names.
Okay, thank you. So predominantly all the portfolio managers on this panel are very much bottom up stock pickers, but I don't believe you invest in a vacuum, and long-term cycles and macroeconomic factors are always important considerations. So my next question is for probably Andrew, if you can start. You know, looking if you next 10 years, what do you think are the important trends or macro factors or cycles that you think your portfolios probably need to consider in the portfolio construction process?
Right. I'll comment on two factors. The one is we had 20 years with absolutely no inflation. Then inflation caught people by surprise. And now people think the base effect is going to cause inflation to disappear quite quickly over the next 12 months. It wouldn't surprise me, given the fiscal stimulus, the huge deficits many countries are running, that actually inflation sticks around for quite a lot longer than expected. People should be aware of that. The other big, and this is more of a market trend, is the US has led global stock markets for the last 10, 15 years, becoming plus 70% of the market. I would caution people that over the next 10 years, it may very well not be the US that leads returns, and I would encourage people to look elsewhere and possibly whether that be Japan, Europe, emerging markets, where one might find more pleasant returns over the next decade.
Thank you. Jared, do you agree with that, or want to add to that, or disagree with anything that Andrew said?
Can't disagree with certainly the first part. In terms of the second part, maybe taking a more mainstream kind of approach. I think if you're investing over a lengthy period of time, it's very difficult to be comfortable in investing in one, say, geography, like, let's say, an emerging market, just given the geopolitical risks, the lack of transparency, poor management, et cetera, et cetera. So I think you can dip in and out of those kind of strategies. But for us, as long-term investors, we like to take an extended period of time or view for an extended period of time, and we need to be comfortable that there aren't going to be any quantum shifts in terms of the strategies, the politics, and the management, and the type of businesses that you own. So I know it's very generalistic. So I would say that I would stick to the US. It's just the highest quality management team, the best transparency, the best liquidity. And yes, maybe the returns in the short term are looking a little bit juiced up. But I think over the long term, it's a market you can sleep easily at night, making very good returns if you pick the right stocks. And I think the problem right now is there are a lot of crowded trades, particularly in growthy, techie type sectors, which have led to valuations that look quite expensive. You know, one of your questions was about passive investing. This amplifies the problem when you have all this passive kind of money coming in and buying the same 6, 7, 8, 9 market capital stocks, pushing pricing up. So it becomes a self-fulfilling prophecy on the upside and the downside. But having said all of that, we like long-term quality businesses where, as I say, management team, geopolitically, and moat are very important. And for that reason, we'd stick to no one theme, but just great quality businesses.
Thank you. So we touched on inflation being higher for longer, maybe is a consideration for the next 10 years. Looking back at the previous 10 years or so, the dollar has been very, very strong. Question for Simon, your view in terms of the dollar over the next 10 years, and more importantly, how does that view, if you have one, play into your portfolio construction? When you invest in different regions, do you ever hedge the currency, or do you just invest in companies and leave it to their fluctuations?
Yeah, David, I think the short answer to that is that we don't really look at currencies that much. I guess it depends on the degree of dislocation. If you're invested in Turkey or Argentina or somewhere, then I can see currencies playing a big role. Our funds are mostly invested in the US, to a slightly lesser extent, Europe, from time to time, Japan, or China. Those currencies are a lot less volatile, certainly, than the movement of the underlying shares. So, it's not something we spend too much time on. If we were invested in, let's say, a Japanese exports business, for example, we probably would have a view on the yen, and we take a look at it. But even then, we consider something like long-term purchasing power parity or something, i.e. real exchange rates mean reverting or something. We wouldn't spend that much time on it. I think the more interesting thing to me is, on your question of change, I think there are some things that I think are very exciting, and that's sort of an area where we've spent a fair amount of time on, is artificial intelligence, is general AI, large language models. It's nothing new. I think if you think at the moment things are changing rapidly, I think the rate of change is going to accelerate. And that's something we are spending a lot of time on. I think that's a pretty high conviction prediction. It's not entirely new, but I think the recent breakthroughs in those areas are absolutely astonishing, as you move from simple sort of pattern recognition to more sort of intelligent forms of prediction. And I think the other big change is that those like generative AI, LLMs, those are being democratized, because cloud computing now basically means that anyone has access to pretty much the latest chip, the best processors, capacity, speeds that money can buy. So, it's no longer in the domain of a handful of big companies, but it's now open to anyone. So I think we're on the cusp of potentially a massive boom in productivity. And there are a few areas around that actually excite us as quite a bit. You can just look at like what Tesla's, for example, doing at the moment on autonomous driving. You can look at what's happening in the coding and programming industries, teaching, medical imaging. The list goes on. I think it's very exciting, but I think it's a double-edged sword, because on the other hand, and this is maybe one thing that keeps me up at night, is that I think entire industries will be disrupted. And my paranoia is being on the wrong end of this. And I think one of the most challenging things for us as investors, especially for investors who are valuation cognizant and valuation sort of based, is to avoid the value traps. So to avoid companies that look cheap on historic numbers but are on their way to zero.
Thank you. I'd like to go a little bit deeper on this AI. I attended an investment conference last week in London. I would say 90% of the discussion was on AI, but specifically AI and its potential impact on how you actually manage money, not in terms of investments. Have you start with Ben, considered any changes to, or foresee any changes to, how you manage money or investment strategy with what's happening in the world of artificial intelligence?
You mean specifically in company-specific stuff you would consider investing in rather than the process?
Actually talking about process, your investment process, how you go about things. What do you foresee a change?
Sure. Well, I guess, it does have a lot of time-saving advantages for a lot of industries and grunt work and processing. I suppose there's an element of that comes into the job, but it's just not the reality that we're looking at 5,000, 6,000 companies, in which case it probably would be more useful. I'd say by and large, we are picking over a universe of anywhere from 100 to 150 names. I think where it could be useful is just, in terms of keeping on top of that names. Right now, everyone has different ways of going about it, but you can have relationships with various brokers that know you're interested in specific names, and they'll alert you when certain things happen, and you can set up your own manual alerts through various programs. But if you could have an autonomous agent kind of helping out with some of that work and summarizing some of the reading we all have to do, I'm sure there will be some productivity gains. But remains to be seen.
Thank you. Does anyone, maybe Jared or Andrew, foresee a fundamental change in the way you would manage money over the next 10 years due to technology and AI, or are you pretty much in alignment with Ben?
If I may, sorry, go ahead, Jared.
I think what Ben, we manage money very similarly to Ben. We also don't cover 5,000-6,000 stocks. Our universe is probably around 150 stocks. So I think in terms of just that screening tool, we can certainly speed that up, get that a little bit more slimline. But it also depends on how clean the data is and how things look going forward. And I think you've got to assume they're going to get better. So I think a lot of investing is, the first stage is easy in terms of screening for what you want. The more kind of nuanced bit of it is actually interpreting the data and taking views in terms of where things are going to play out in the future. And I don't think AI is going to help you predicting the future. I think it's very good at disseminating information and separating it and then giving you that information. And I think ultimately, when it comes to stock picking and taking views of where things are going to be going forward, it's not going to give you that informed decision.
Andrew?
Yeah, we are a very small team and we look at a very large universe. So we've been using various forms of technology to narrow that down for a long time. Hopefully that technology that we use becomes more sophisticated. But for sure, I think AI in general will make this business more competitive. And it has been for years. There are a lot of very sophisticated, what you would call quant funds, but I think they're more than quant funds who take out a lot of the market discrepancies that maybe you had in the 80s or 90s and early 2000s, whether that be Renaissance technologies, etc. Many of them have incredibly strong track records, and there will be more of those, and it will become more competitive.
Andrew, you mentioned that you would warn investors to maybe avoid the US being a one-way bet, which it has been largely driven by the mega caps. But if I can flip that question around, where would you, let's say a 5 to 10 year outlook, which geographical region would you think offers the most compelling returns if you look at all your bottom-up stock analysis?
I guess maybe I'll kick off. At the moment, we've got quite big investments in both Europe and Japan. Why? It's all about valuation. So if I may just give you some contrast. So we had a position we now reduced a bit in Komatsu. You contrast Komatsu and Caterpillar. So Caterpillar is listed in the US, Komatsu's in Japan. Komatsu's track record, ROE, earnings growth, etc., substantially better than Caterpillar. Okay? Valuation, about half. And another point I'll make in terms of management being on your side, the CEO of Komatsu earns about $800,000 a year. The CEO of Caterpillar earns $20 million a year. Okay, so and you look at the levels of pay, etc., and that's across the board staff. The costs of things in the US have run away from many other countries in the world, and you might see some kind of reversion there. And a lot of the flow of funds you touched on passives have gone to the US. Why? because it's done very nicely, and there are lots of very big tech companies there. But if, like us, you're looking in the mid-cap space or the smaller cap space, you can find many businesses that actually have great track records, great businesses. Another one of our stocks has done very well, Mizuno. I don't know if any you play golf. Mizuno is a big sports company, very strong brand, the biggest producer of golf irons in the world. It might even fit in Ben's category, branded, net cash in the balance sheet, etc. We were buying Mizuno with its great track record at less than 8 times earnings. Okay, now suddenly Japan's becoming in favor, it's grown. If you find a similar branded consumer good in America, Lululemon, I don't know what that trades at, 50 times earnings. So those are the kind of opportunities we're searching out. And that's our job for you as clients, to seek out these undervalued opportunities.
Thank you. Simon, do you agree with that, or any other areas that you think outside of Japan and Europe that you think on a valuation perspective is looking?
I mean, look, so we don't really take a sort of a geographic approach to things, but I mean, if we were to, and you had to ask me where would I be invested over the next 10 years, I'd pick the US. The US is by a long way the largest market. I mean, at the moment, our fund is sort of, I think, 83 or 84% invested in the US. It's by a long way the largest market. It's got the best liquidity, the lowest trading costs, and great disparity. So, I mean, I don't disagree with Andrew. There are shares in the US that we think are very expensive, but those are shares we hopefully don't own. We see massive disparity even within the US. We also see the most innovative companies in the world, very strong corporate governance, strong respect for the rule of law. So I think as far as we're concerned, if I had to pick one geography over the next 1, 5, 10, or 100 years, I'd pick the US, first, second, and third place.
There's one comment, if I may, Simon, comment on the US that I think a lot of people miss, and I'd encourage people to look for it, is this whole thing of management working for you. So a lot of US companies make a lot of noise about buying back stock. Google, Facebook, etc., buying back vast sums of stocks, billions of dollars of stock a year. Interestingly, do yourself a favor and look at the shares in issue. Have the shares in issue actually declined or not? And what a lot of all those buybacks are actually going to offset dilution from management stock options. Okay, so actually all the cash flow is effectively going into buying back stock with just offset management stock options. So actually all the cash flow of business is going to management, and it's something I'd caution people to look at very carefully before they buy a US company, where the cash is going.
Thank you. Nice, different views. Jared, just I think you touched on this year being very much a mega cap driven market, very hard to beat the big indices given their weightings. In terms of how you see things going forward, given the run, any words of advice for investors or a view in terms of the valuations of those, Super 7 companies that have really been driving the year-to-date returns?
Yeah, I mean, we've been here before as running the kind of strategy. I think a lot of the guys here on this forum run. We've been in many situations where you're fighting the trend. So I don't think it's surprising. It's frustrating at times. So the advice is you've got to keep doing what you do, which is keep buying the good quality businesses through a cycle. And things change, and we saw how things change very dramatically in 2022. And as long as you're in good quality businesses, your stocks will re-rate, or earnings will come through, or the margins will come back, and whatever the reasons for buying those stocks are will go through a cycle. So time will tell, and the quality always floats to the top. So no real advice. I think I'd be wary buying these techie kind of names, even with this big AI kind of push forward. I don't particularly think interest rates are coming down very quickly. So I don't think DCF modeling and all that's going to help growth in the short term. So I think you just got to stick to your guns right through the cycle, and you can't judge stocks or stock pickers on a 3 or 6 month view. You've got to take 3 to 5 year view and see how you actually perform through a proper cycle and through different stress tests, and that's the proof in the pudding.
Thanks. Coming from a completely different angle now, people obviously and investors ask you questions all the time, but if you had to impart one piece of advice to allocators of capital when they're deciding on investing in a fund, what would it be? And I'm going to start with Ben.
Sure. Yeah, no, it's a good question. And I think it's the same thing, you'd probably advise the people looking at a company or a company's management, which is try and meet them over a very long period of time and write down everything they say, and then look back over previous notes and see if they've stuck to it. And obviously it's a lot easier when you're doing it with public companies, because you've got, 20, 30 years of earnings calls or reports or strategies and so on to track. So then if you're meeting managers in person, obviously it's a slightly more private channel. You do have to put that effort in to write it down and hear their thoughts, but just look for integrity and thoughts that remain consistent over time. Someone you can trust.
David, you're on mute.
Thank you. Simon?
That was a great answer, Ben. I don't know if there's much I can add. I guess the other thing maybe to add is that you should find a fund that follows a philosophy that aligns with yours, a philosophy that works for you. As an example, if your objective is to minimize tracking error, then maybe we're not the fund for you. You'd probably be better off in a very low-cost passive index tracker. So find a philosophy that works for you. Make sure the managers of that fund are aligned with your clients, be that through fee structure, be that through ownership of the fund, and most importantly, I would think co-investment in the fund. I think Ben's right. Make sure it's someone with integrity. I think that's often an overlooked part. And then the most important final thing is to then stick with that strategy through thick and thin. It has to be a long-term relationship in order for it to work.
Andrew, want to add anything?
Yeah, I think that thing of make sure you understand your fund manager's philosophy, because to Jared's point a second ago, there are periods where all philosophies underperform or outperform. You must make sure if you understand it, you'll stick through with that manager through the long term. And if I may, I'll say a quick punt. If you go to randmorefunds.com, to the fund section, I actually wrote a thing last year that's got 9 points that I think it's 9, that a asset allocator should look at when they're looking at a fund. And it's touched on a few of these and a few others. So, yeah.
Okay, good. We will have a look. Jared, any further points you'd like to add, or do you think we've covered it?
Yeah, I think another point is the tenure of the fund manager. I think it's important that you pick a fund manager who's been through many different scenarios and different cycles. If you've just come into the industry and you've been in it for the last 10 years, you've only seen one-way traffic, low inflation, low interest rates, everything's techie, everything's growth. It's easy to make money and believe in that philosophy and kind of stick to it. And so I'd say tenure and experience is obviously very important. The second thing is style drift. You've got to be very, very cognizant of making sure that your fund manager does not change his strategy or style or start picking stocks that are different to his underlying investment philosophy. And those would be really my two additional points.
Jared's got our website open. We just stole point 3 and 8.
Yeah, you should come to the Credo Group website. We've got a similar kind of philosophy on there as well.
Okay, let's get back to the panel and less on the websites for now. So next question, I think, Jared, you mentioned, and you touched also passive investing and how that's becoming more and more prominent everywhere. But more specifically, how that's impacting your investment strategy going forward. Has it impacted? Is it creating more opportunities? Is it creating more difficulties in the way you manage money? Starting maybe with Ben.
Sure. I think the short answer is probably not. You know, I think the temptation maybe when you do have an increasing part of the index being driven by 7 stocks and they keep running away, you know, not, you know, some might, you know, want to have sector weights in those just to at least keep up and then try to do things around the edges and so on. I think that's incredibly dangerous. You know, if anything, this rise of passive just underlines a stronger case for why active needs to outperform by being different and, you know, minimizing that kind of factor risk by, you know, you've got to be differentiated, and that's how you'll try to outperform. But maybe it's an increasingly hard index to compete against, who knows.
Simon?
Look, I guess there's a short and a long-term impact. In the short term, I think it probably does result in a slightly higher sort of correlation of returns, and also probably a higher degree of price distortion. But then, so I think markets become less efficient. And I think valuation disparity, which, as I said earlier, is our bread and butter. I think over time, it results in greater valuation disparities on the market. And I think that's decidedly positive for us.
Okay,
Yeah.
we've got.
I'll say just on that, if I may, David, and there are 2 great things about it. The one is it puts free pressure on the industry, which is fantastic for clients. It brings down costs for clients across the board. And the second point I'll make, it drives people to certain sectors. It results in less competition where we operate. So for me, it's fantastic.
Thank you, Andrew. We've got 7 or 8 minutes, and I think there'll be some questions from the audience. So this will probably be my final question. You know,
It's just me.
Or if you had to think that there's one, I am here.
Are you back? Cool.
Okay. If there is one risk that you think that will affect the markets, that you think the current valuations and markets are mispricing and probably keeps you up at night, what risk would that be? If it's a recession, a geopolitical risk, or a valuation risk, what is first and foremost in your minds? And I'll go around to close off with asking everyone that question, starting with Ben.
Yeah. Well, maybe we all throw one into the ring. You know, we can all have a kind of litany of woes because, you know, there's you know, a lot to worry about. Maybe, you know, I think the Chinese consumer has been a massive driver for a number of sectors and a number of, you know, stocks that we own. So kind of Chinese repatriation of demand is a pretty interesting one. And yeah, let's see how that evolves over the next 5 to 10 years.
Simon?
Oh, I mean, I'm gonna. It's a tricky one to answer. We tend to look further out, and on a longer time scale, all these shorter term speed bumps become far less relevant, I guess. In the long run, I think we remain optimistic. I mean, on a long enough time scale, you'd be crazy to bet against human adaptation, ingenuity, growth. You know, in the short term, the pessimist might sound smart, but in the long term, the optimist makes money. So I don't think we are overly concerned about any specific issue in the short term. If and when something comes up, it's probably going to be something that we can't forecast. And hopefully we would be very quick to respond to any shorter term threats.
Great. I like that quote about the pessimist and optimist. I'm going to write that one down. Jared, anything you want to add?
No, I think, that's the whole thing about the market, is that you can try and anticipate the known unknowns. Everyone's kind of fretting about retail property, commercial property, about recessions, about bad debts, loans, etc., the Chinese consumer. I think those are that everyone's already factoring a lot of that into their models and into pricing and whatnot. So it's the scary stuff. You got to be like a bit off the charts here. AI chips are going to take over the world, and we're going to be, it's ridiculous stuff like that. And again, you can't forecast for that. So we don't really worry about. We worry about what we can see in front of us, and I think a lot of that's already priced in terms of the models. We try and price that into our models over 3 to 5 years. And if something happens in the interim, you got to deal with it and move on. But nothing really scary that's worrying us that's not already out there.
Thank you, Andrew. I think you may have answered the question previously with some of the insights you've given, but I'll give you a chance to maybe add or focus in a specific area.
In pure market risk for investors out there maybe listening to this call, something that's is glaringly obvious is many large tech companies are priced for very strong growth. And it's quite likely, to my mind, that growth doesn't materialize for a couple of reasons. One, it's very hard for very large companies to grow fast. And two, there's a huge profit pools that people are trying to erode. And to Simon's earlier point, much of this AI is potentially breaking down the barriers to entry to these profit pools.
Great. Gentlemen, thank you for being a part of the discussion and the panel. I'm going to hand over to Eugene just to ask any questions from the audience. Eugene, do we have any questions?
Yeah, David, thank you for that. There's a couple of questions coming in from the audience, and maybe if I can direct the first one to Lindsay Train and your position on WWE. I mean, we discussed it in the BCI Global Investment Conference as well, as one of the stocks that you hold. And the question is, are you going to stick to the current stock selection in your portfolio, or when do you rebalance your portfolio? Does WWE have a long future in your fund?
Yeah, I mean, for those that aren't aware, WWE is the wrestling company, and there's a current plan in place where Endeavor are spinning out UFC, Ultimate Fighting Championship, and they're going to combine it with WWE into an ultimate kind of fighting hybrid called TKO. And yeah, so the question, I guess, is, are we going to continue to hold WWE, which we've held for more than a decade, as it gets rolled into this combined fighting entity? I'd say we're, the event will happen in the second half of the year. As it stands, we still have the same position that we've been holding. We're fairly optimistic about the future for sports rights and media rights in that space in general. We've got a couple more meetings scheduled with the management of the combined entity, but we think it makes a lot of sense. On rebalancing, yeah, we do not rebalance. We don't tweak with weightings pretty much at all. We like to just kind of step back and reduce the unforced errors.
Yeah, thank you for that. Very interesting question from one of our audience members as well, and it speaks to the valuation of companies. And I'm going to ask Simon to give us the first stab at this, but anyone else, all being value type managers, to add commentary. And the question speaks to, if you look at valuations of companies, or when you do valuations, whether it's price to earnings or price to book ratios or intrinsic values, I mean, there's different measurements that can be used by all of you. How correct are some of these valuations of the companies? So it's a price sometimes not wrong, or the earnings that you forecast not incorrect. Maybe, Simon, if you can give us a better understanding, if you do valuations on companies, looking for value-based companies, what is that matrix that you look at, and how true is that when you look at it?
Yeah, I mean, it differs very much by company. We certainly are very valuation conscious. So we try we try to basically normalize the conditions that the company operates in. And in doing so, we look 4 years out into the future, and we perform a total rate of return calculation and expect a total rate of return calculation between today and in 4 years' time. And then we follow the journey between today and in 4 years' time very, very closely. So there is a sort of a path dependence. So as the company reports its results over the subsequent quarters, we look at whether that tracks, sort of whether that's in line with our expectations. If we're wrong, why are we wrong? Of course, we know that we can't predict the future, so one has to be pretty humble about that. And if things change that change the thesis, we have to be quick to respond and adapt and change our minds, and take the appropriate steps, whether it is to double down on the company or to sell out of that position if we realize that the thesis has changed. I think the one very important thing, because I think a lot's been said this morning about quality, and if you're buying a quality business, you'll be fine in the long term. I think that is quite a crowded space at the moment. I think a great business doesn't necessarily mean that it will be a great investment. And you can look at, I mean, even in the case of South Africa, so companies that most of the audience would be well familiar with, a company like Tiger Brands, for example, which has some of the strongest brands. It's a consumer staples product. They are not subject to sort of any major disruption whatsoever. Fantastic brands. Well, they've underperformed the Offshore Index by 70% over the last 10 years, or even a company like AVI has underperformed the Offshore Index by probably 50% over the last 5 or 6 years. So I think one has to be very careful of overpaying.
I think we have a question.
Anybody else want to comment on that? No, that's fine. I'll step up to the next question. And Simon, I think it's going to link up to what you just said. I mean, being a value manager is not just buying stuff that's cheap. It's also, buying quality companies that has good potential earnings. And I think it speaks to one of the questions from the audience as well. How do you draw the line between, or prioritize between, growth of a company versus the price that you buy a company at? And Andrew, if you can maybe comment on that, from your investment philosophy view from Randmore, you look at valuations, but how do you balance that between finding a company at a good price, but still have some growth characteristics as well?
Yeah. I mean, so we would all love to have companies that are cheap and growing fast. And it's all about balancing those and what you can find. And we are, I think Simon mentioned the word, very cautious about value traps, because it's about cash flow and what that business does with its cash flow. Is it reinvesting it at a 0 rate of return, which many companies are, or is it reinvesting it at a good rate of return, or is it returning to shareholders? So you can get your returns through many ways. You can get your returns through dividends, you can get your returns through growth, etc. So it's all about working out how those fit and looking at the risks. So there's a risk of the company derates, there's a risk of the company stops growing, and balancing these up and deciding what's a fair price to pay for any given cash flow stream. And that obviously that's what makes the market. Some people might think a fair price to pay for this cash flow stream is 25 times earnings. We might think 12 times earnings. And it's depending on how solid you think it is going to continue.
Yeah. Jared, I don't know if you maybe want to comment on that as well, because I mean, you bluntly said, and it's always in your statements as well, it's you invest in terms of where value and quality, at that intersection. So again, reiterating, it's not just about buying cheap companies, but if you're a value manager, but you also look at quality companies, what is some of those key factors that you are looking at, and can you maybe use an example of one of those stocks that you are looking at?
Yeah, so without being quirky, I mean, we use a term which is value at a reasonable price, as opposed to, say, growth at a reasonable price. And I think it's all been covered by Simon and Andrew before. There's their KPIs, their drivers in these businesses that are key to where these businesses are going and how they're going to perform. And very much like Simon, when we do invest in businesses, we look at a TRR, and that's broken out through multiple expansion, margin expansion, cash flow, dividends, buybacks, things like that. And so you've got to break down all of those components and try and be pragmatic in terms of where you think there could be some growth through multiple expansion, or whether margins are through the cycle depressed and whether they're going to expand, et cetera, et cetera. And again, you've just got to be, as I say, pragmatic. So, off the top of my head, a good stock that's performed well for us is a company called Flutter. Now, Flutter Entertainment is not a typical value stock. You look at it, it trades on a very expensive multiple. But when you start breaking down the actual components of the business, you realize that they're a gambling business. They do online gaming. They're the biggest in the world. They were very big in the UK and Europe. They're market leading in Australia. Generated their number one position through regulation, through all hardships in terms of becoming number one, even though the industry has actually regulated. And they've taken that cash flow and they've gone to the US. And the view there is, well, who's going to succeed in the US? You have cheap money, and you have a lot of people who can throw money at it in their own hometown. But the view we took, and rightfully so, is they have the best risk and management. They have a technology stack, and they own it all. And they happen to partner with another business called DraftKings, and the history of this goes on to the fact that every time a new jurisdiction legislates in the US, they take market share, and they are either number one or two in that space. But the point I'm making is, when you looked at the actual figures of the business, on the face of it looked very expensive, because they were losing $300-400 million a year on expanding to the US. And now that's changed. At the end of this year, they will be profitable. And that kind of that headwind is turning into a tailwind. And if you look at the opportunity of what the size of the US is, the runway there's a decade long, and so this now then starts churning huge amounts of cash. The multiple comes down excessively quickly, and the stock looks actually quite cheap. So you can't always just look at a multiple and say, too expensive, too cheap, or value trap. You've got to really dig into the weeds and try and understand these businesses.
And I think that really reiterates, a lot of the commentary that's been made by you and some of the questions that David had as well. Maybe a very, very last question. And it speaks to levels of conviction. Many speakers elaborated previously on high conviction areas, but are there specific areas where conviction is deteriorating at the moment? And in line with this, are there any new areas of conviction that you look at in your portfolio? Ben, if you can maybe start with that, and I'll go around and everybody can give really a 10-second or 15-second comment on that.
Sure. Well, I suppose we've only got 3 pillars. So if we had losing conviction in one of them, things would not be good. But I suppose, one area within media where other people maybe have uncertainties is around the future profitability of streaming as they're trying to transition from cable networks to streaming. And we have various companies that are exposed to that. So maybe that's where some people have low conviction at the moment, but let's see how it evolves over the next 5 years.
Yeah, Andrew.
Conviction to me is a very dangerous word. I don't think you should have conviction about much when you're talking about the future. You've got to have an open mind and look at the odds, and it's just, so I wouldn't say we have high conviction about everything. We think our stocks are undervalued, but we're always very cautious and paranoid about it.
Yeah, Jared.
Yeah, so like Andrew, I think the better word than conviction is sentiment. I think there's a lot of negative sentiment on a few sectors right now. Healthcare, insurance, tobacco, unloved at the moment and screening quite cheaply. So that's where I'd be looking.
Very interesting, Simon.
Yeah, so I mean, our portfolios tend to be fairly concentrated. I guess our three sort of larger buckets of concentration are the sort of offshore oil drillers, the media stocks. I think Ben alluded to those that are moving from sort of a previously sort of intermediated cable type bundled environment towards a direct-to-consumer business. I think those will be substantially better businesses in 5 or 6 years' time than people currently expect. So that's our second bucket of concentration. And then we've also got the delivery and mobility companies is our third bucket of concentration. So I guess you could perhaps say that those are the three sort of areas of conviction for us. But I think to Andrew's point, you know, we are happy to change our minds. And, you know, when new data comes out that sort of disconfirms any of our existing beliefs or theses, we will be happy to move on to the next best opportunity.
Yeah, it's a dynamic process all the time. I mean, it's not
Yeah.
just buying and hope everything goes well. I think, gentlemen, we're going to end that session with that. There's 1 or 2 open questions. We'll circulate that around to you as well if you want to add more comments, and we'll get that back to our audience. To our audience, again, thank you so much for joining us this morning. To David, Ben, Simon, Jared, Andrew, you've made for a very interesting conversation this morning indeed. And I think the takeaway, obviously, still a lot of companies out there with good valuations offering good growth in earnings looking forward. So it's not just looking at the intermediate or short-term global macros. You still manage to find good value in a lot of strong companies with good, solid earnings. For our audience out there, if you want more information on the funds or the fund managers, can find it on the BCI website or the new boutique managers website as well. All the information's there on the BCI feeder funds for Contrarius, Credo, Ranmore, and Lindsell Train. David, again, thank you so much for being our moderator this morning, all the way from Israel, and safe travels. I believe you're going to travel for the next couple of weeks. And as well, if you need more information on Corian, please feel free to contact any of the BCI sales team, and we can get you a hold of either David or any of our presenters this morning. Gentlemen, thank you so much for dialing in. As always, it's been great having you. And to our audience, looking forward to seeing you next week, Wednesday, 5 July, when we have Batelier with us to discuss matters further. To all of you out there, be safe and stay warm. And thank you so much for your continued support. We'll chat in the very near future.